This talk continues a topic in Chapter 9, receivables, accounting for receivables, their valuation. The key terms in your chapter, and by the way, I'm using a textbook that's not your current edition, so the page numbers won't line up, but there were two methods talked about in your textbook, the direct write-off method and the allowance method. Again, the direct write-off method, companies wait until they know a specific customer, the receivable will not be collected. They may wait 6 months, may wait a year before they write it off, before they make the entry, debit bad debt expense, credit the allowance account. The allowance method, which is GAAP, which is the focus of this chapter, although I want you to be able to recognize this method. The focus of this chapter is the allowance method. It's generally accepted accounting principles. Any company with significant credit sales needs to use this method to conform to proper accounting. This uses an estimate of bad debts. It doesn't wait until it knows a customer, but it makes an estimate not knowing any specific customer, but it makes the entry, debit bad debt expense, and creates an allowance account. The allowance account is a contra asset account. Again, the allowance for doubtful accounts, sometimes entitled the allowance for bad debt expense, interchangeable accounts, is a current asset account. It's a contra asset account. Normally has a credit balance. It offsets the balance of accounts receivable. The net of those two numbers is the net realizable amount that's expected to be collected from customers who have an account receivable. The allowance method use of the allowance method can be done in two separate ways as indicated in your textbook. Two different approaches to implementing it. The percent of credit sales or percent of receivables. Percent of credit sales is known as the income statement approach. Percent of receivables is known as the balance sheet approach. This is a one-step approach. This is a two-step approach. Companies simply choose the method that they want to use to implement the allowance method and stay consistent with it. Looking back at your key terms in the chapter, percent of sales method. I'll call that method 1. Very simple. The second method percent of receivables. Your chapter actually presents two types of percent of receivables. They're the same method, just different ways data is presented. I'll comment on that later. Using key accounts to explain the two different methods to use the allowance method. One method is to concentrate on net sales, net credit sales of the current period, and at the end of a month or a quarter, based on experience, a company takes the percent of net credit sales that it expects to be uncollectible and makes this journal entry. Debit bad debt expense, credit allowance for doubtful accounts. Again, it's on an estimated basis. They don't know specific accounts that will be uncollectible. Estimated basis so they can book an expense in the same period that they book their credit sales. Matching of expenses to sales to give a better net income picture. The second approach for making the same journal entry is to look at a percent of the receivable account at the end of a month, at the end of a quarter. So looking at a percent of the receivables, making a calculation. That calculation actually is what's called a target amount, the balance that a company wants in their allowance for doubtful accounts contra account. But before they make the journal entry, they have to look at any preliminary balance before they make this journal entry. So this balance sheet method that looks at percent of receivables that'll be uncollectible is a two-step process. One, make a calculation to get the total amount, desired target amount in this account. And secondly, looking at any balance in this account before it makes this journal entry to update it to get to that target balance. The first method, the percent of net credit sales, simply looks at the current period sales, takes a percent of that, and makes this entry directly, and just simply lets this balance move on as per normal. But the second method, percent of receivables, balance sheet oriented, not looking at sales for the period, but at the resultant receivables and doing an estimate of that to get to an ending balance, ending targeted balance, and then making whatever entry is needed to get to that balance. A two-step process in the balance sheet approach. So with this percent of sales approach, the one-step approach, make a calculation, make the journal entry, debit bad debt expense, credit the allowance account. You're loading up the allowance account every time you make this estimate entry, debiting bad debt expense. Now to contrast that to the percent of receivables, the two-step approach, let's presume that I had a receivable balance at the beginning of the year of $300,000, had some cash collections, and so at the end of the quarter I had a net balance of $250,000 debit in accounts receivable. The percent of receivables says what estimate of my receivables, many months of sales, that's a period of time, will be uncollectible when I make this journal entry. Let's presume it's, we estimate 1.5%. That times that equals 3750. So at a point in time, we analyze the balance sheet and we say this much is uncollectible in the future. This is a target balance that I want in the allowance account, but I can't make a journal entry yet. Step two is I have to analyze the current balance in receivables. Now I wanted a target balance of 3750 using the balance sheet approach. Again, just based on experience, 1.5% of a balance is uncollectible in the future. So 3750 is my desired target balance. Credit. But I can't make a journal entry yet. I have to analyze if you look at my current balance in that account, and over time, by the way, that's going to change. I can have balance in it. I have some actual direct write-offs. And so at a point in time, when I make this estimate, my balance is $2,700. What difference do I need? I need $1,050. That's the journal entry I need to make this journal. Debit bad debt expense, credit the allowance account. Because that journal entry of $1,050 brings me up to my target balance of $3,750. Hence, that's why it's called a two-step approach. Calculation first, to get my overall balance that I want in the allowance account of future uncollectibles. Then look at my current balance, and it's the difference of that I want to make the journal entry on. As opposed to the percent of sales method, which says make a calculation based on current period sales and make the journal entry right away. Again, companies have to choose which method they want to use, percent of sales, income statement approach focusing on current credit sales of the period, or a balance sheet approach looking at the resultant receivables at the end of a month or a quarter. Whatever approach is chosen, they simply should be consistent from month to month. Now, to focus for a few minutes on this percent of receivables approach, the balance sheet approach. Again, your chapter talks in terms of a percent of receivables method and an aging receivables method. They're the same thing, just how the data is presented in the problem. An exhibit in your book shows the aging of receivable method. That's simply taking your total receivables, $6,375, breaking them down to how old they are, current, less than 30 days old, 30 to 60, etc., breaking them down and applying different percents of uncollectability to the aging. The more current ones, 1%. The older a receivable gets, the more likely it will not be collected. So it's applying different percentages to the different agings of the receivable to come up with a total amount of targeted uncollectibles at a period of time. 42 for current receivables, 17 for up to 60, 36, 90, total of 183. So they're demonstrating the aging of accounts receivable. I'll take the same data and show you the percent of receivables method. So 185 is what they want as the target amount balance in the receivable, in the allowance account. If I took that same 185 as a percent of the total receivables, I get 2.9%. So I could say the percent of receivable method is, this company estimates that 2.9% of their receivables would be uncollectible, or $185. So it's just the way data is presented. Either they give you individual amounts by the aging receivables to come up with a calculation, or they give you an overall amount on receivables to come up with a calculation. Now, I'm using the same chart here deliberately, but there's the aging approach, or I could say our experience has been 2.9% of receivables to the 185% of receivables. It's the same method. And whether it's an aging receivables or what I call percent of receivables method, the key is you're determining the target balance first step. Then you're analyzing what your current balance is, evaluation of the current balance in the allowance account. Whatever that current balance is, let's say it's $100. And the last step is to actually make the journal entry I want 185 as my target balance, and so therefore the journal entry is $85. Debit bad debt expense, credit this allowance account. Every time we credit the allowance account, we're loading this account up for future use. What's that future use? Actual write-offs. What's an actual write-off? Credit the account receivable account, removing it from the receivable balance of the company, and use the allowance account set up for that purpose and debit it, thereby reducing it. So the balance in the allowance account is going to be moving all the time. You're going to be loading it up with current provisions, the estimate stage, and reducing it in the actual stage. Going back to a hand-on momentum, in the estimate stage, you're loading up the allowance account. That's when you debit bad debt expense. You're loading up the allowance account with credits. And in the actual stage, when you're writing off a specific asset, you're decreasing the receivable account and you're decreasing the allowance account. You put that balance there to use it later in an actual write-off. So in summary, in using the allowance method, which is GAAP, either the percent of sales, simple method, or the percent of account receivable balance. One final contrast to the direct write-off method, which is not GAAP. The direct write-off method does not use an allowance account. It simply says it waits, there's not an estimate in actual state, it waits until an actual account receivable of a customer is going to be not collectible and they write it off. They will decrease it with a credit and go right to expense directly. Okay, that's the direct method, the direct write-off method, which is not GAAP. It does not achieve the matching. It waits till it records the expense months later after it makes the credit sale and does not get a matching in the current period.